You are listening to Keystone's Stock Talk Show, episode 276.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week as we finish off our final webinars of 2024. On-demand versions were just posted. Get them today. I will start with our star of the week, Argan Inc., symbol AGX on the New York Stock Exchange, a stock which has been a buy recommendation in our U.S. coverage dating back to March of this year. The cash-rich business, which provides a full range of construction and related services to the power industry, enables electrification. It saw share price surge 36% in the past month on very strong Q2 numbers and may be getting a bit of a boost from the Trump trade. Clients will be happy to hear the stock is up 211% since March of this year on our buy recommendation. Brennan chimes in with our second star of the week, which also comes from our U.S. small cap research, Prodex Inc., symbol PDEX on the NASDAQ. Prodex is a medical device manufacturer and was recommended to clients in June of 2023 at a price of $19, has jumped 150% to $47.59. Prodex is up over 55% in the last month alone. In our Your Stock Our Take segment, Aaron answers a viewer question on BCE Inc., symbol BCE on the TSX, a communications company providing wireless, wireline, internet, and television services for residential business and wholesale customers in Canada. The company missed Q3 expectations and is down 26% year to date. Aaron lets you know if the drop is justified or if there is an opportunity. Last but not least, Brett answers a viewer question on Neptune Digital Assets Corp, symbol NDA on the TSX Venture, which operates in the cryptocurrency and blockchain space. Neptune engages in operations across the digital asset ecosystem, including Bitcoin mining, proof of stake, blockchain nodes, decentralized finance or DeFi, and other associated cutting-edge technology. The stock is up 139% year to date, but most of the gains started in October. Brett lets you know what is driving the gains and if it can continue. Okay, let's get to the show. My co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well.
Busy week.
Mm-hmm. Yep. We've got
what happened over the last week. Obviously, a lot of questions about the election. I think the poll relates to the election.
It does, and we'll talk about that. And we finish, well, as we're recording this, a couple hours after this, we'll go live with our second and last webinar. It will be available on demand, but you'll probably be getting this after we actually send it out. And actually after we do the webinar is what I mean. This will be sent out after that. Hopefully that makes sense.
Yep.
And there was that election in the U.S. Everybody talking about the Trump trade now.
Yeah. So the question obviously that we're getting a lot from people is, well, how does this, impact your strategy or your recommendations going forward? As well as, how do I position myself given that Trump won the election? And, the answer is that it really doesn't impact us. I mean, we are going to do the same. The strategy doesn't change regardless of who wins the election, right? I mean, there are certainly things that the party who wins can do over the next 4 years that will impact the market, but it's really just speculation in terms of what level of impact that will have, the timing, what type of impact. So ultimately, Keystone's strategy is always to invest in profitable, growing companies that have strong business models, meaning some type of essential assets or that are solving important problems for the world. And these are the types of companies that will do well over time. There's really no change in terms of how we would position people. Now, of course, as policies start to come out, that gets integrated into the research. But at this point in time, it's really just wait and see what happens. The market went up after Trump was elected. Statistically, the market goes up after virtually every election, regardless of who wins. So I'm sure that the market probably would have gone up if the Democrats were elected as well. But we will just see what happens, what policies are actually brought forward and approved, and then we'll integrate that into our research.
Yeah, and as far as markets going up after an election, one of the things, if you look back over time that markets like is certainty, and at least you have then certainty as to who is in power going forward, so that kind of the markets exhale. As far as, companies or sectors to be invested in with a Trump regime in power, like one of the things that we got for the couple months leading up to was clients, they were under the impression, or maybe rightfully or wrongfully, that Trump would be good for traditional energy, so the oil and gas sector. And we had many investors saying, where should I position myself in this sector, because he's going to be good for energy companies, generally speaking. It's funny because if the messages from Trump and the statements that he made, if you analyze those, like taking a barrel down to like $40 a barrel or $50 a barrel, taking it lower actually would be terrible for energy companies, because I know he's talking about cutting red tape. You still wouldn't be able to make the margin that they need to make at those prices, $40, $50, $60 a barrel, to be profitable and grow those companies over the long term. So energy producers would not be good, and likely in those range you'd see, unless something completely different went on, if there was a complete different metric at play here in that sector, those companies would do poorly in that type of pricing environment. So, we have a name or two that we would look at. We're not going to talk about those on the show today, recent recommendations to clients in that sector, but it's more based on the underlying business, not what a sitting government is going to do. It's because, one of the companies in one case is because a massive percentage of their market cap is in cash, and they're positioned to grow, whether oil's at 65 or 95. We think they can grow over the long term. But it is interesting to see how people believed that Trump would be great for traditional energy companies, and maybe that will occur over the course of the next 3 to 4 years. Initially, if you have prices going lower, that's not good for energy producing companies. So we'll see how that plays out over the course of the year. It's good for you at the pump, for example, but is that doesn't translate into you going out and saying, I need to buy every oil and gas producer right now. If the price of oil comes down, I'm not sure how that's done, but it's, if the price of oil comes down significantly under a Trump regime, it's not the greatest for producers, is what I'm saying. So we have to run through what is being said. Whether or not you can actually have an impact on that is another question too. And if it's done, what is being said actually comes to fruition. Who is it good for? Certainly likely not good for producers if the price comes down. So you got to be careful what you're looking at.
Now, one thing that I will note, just as an aside here, we did a Your Stock, Our Take on Trump Media and Technology Group, which was DJT. It's the owner of True Social. There was nothing really financial to analyze in that platform. There's barely any revenue, no profitability. But I did make a speculation that if Trump did win the election, that there would be good speculative upside in that stock, that it would move up after the election, just given the fact that the president of the United States would be using it as his main media source. But as we can see, that has actually not happened. The stock price did not skyrocket up after the election. In fact, it's, I believe, maybe down a little bit. And I think that a lot of the reason for that is because he's, back in with Twitter or X, whatever you want to call it, and Elon Musk. So it's, it seems that he's going to be using X more, and won't be as dependent on True Social. And these are the things that you just, you can't necessarily predict going forward. It's always possible to make like a assessment of a situation where if one thing happens and it's a high likelihood that something else is going to happen, but there's so many variables that will come into play that it's just, that's why predicting the future is usually just a fool's errand.
Yeah, and the best thing to do is, as and Aaron just talked about, this is positioning yourself to own a business that is a good quality business, growth, good balance sheet, all those things that may be benefiting from general trends that are there regardless of what government is in power. If one accentuates those trends, fine. And we'll talk about a company today, Argan, which, many people have now stated that they think the Trump boost will help, or the Trump trade will help them. Energy infrastructure is where this company plays in, and electrification, but a staged electrification, and could benefit from a Trump regime. We don't know if that'll happen, but when we recommended it in March of this year, we didn't say, well, this is hinging on Trump's election. That would actually be very stupid. Even if we were 100% guaranteed that Trump was going to be elected, you want to make sure that that business is solid then, and is going to be solid whatever sitting government is in power. Plus, you don't know for certainty what that government in power is going to do. So pick that solid business. If you happen to get the wind at your back because that sitting government has policies that favor that company, that's great. But make sure it's going to perform whoever gets in power, is what we would say. And, typically taking short-term views like that is just terrible investing, to be honest. And there are companies you can, in our portfolio that we would have, thought that would do well under one regime versus the other, but none are in there that are going to get crushed under one of the other regimes. And they're just probably going to do well and do quite a bit better if there is a regime in there that happens to push a wind at the back of that company. But you got to have a company that can do well in any sitting government, because it can change, and their policy in that government can change midterm. So if you really are basing it on what the sitting government is, it's not a good portfolio. And it depends on that, is what I'm trying to say. Okay. Any comments on that, or do you want to talk about the poll? Because that kind of gets...
I can quickly just go in the poll because it's related to it. So the poll is with the U.S. decisively. It was a Republican sweep, which I think that I was looking at the betting odds because everyone was doing that this election. I think like 20-25% odds that Republican sweep, something like that, prior couple of days to the election. So Republican sweep wasn't really the market was expecting, but it's decisive. And like Ryan was saying, the market likes certainty, no matter who's in. The market likes certainty, and that really adds to the certainty what policies, if anything, you are going to get through. But obviously, like we were just talking about, the effect of those policies and the implementation matters more so than just someone getting in. But so the poll, has your general outlook on stocks changed now that the results are in? 56% said that they are now more bullish, 22% says their outlook hasn't changed, and 22% say they are now more bearish.
Yeah, I think we all know where I voted. Absolutely no change whatsoever.
Me too. I also voted no change.
Yeah, and mine would be more where the current valuations are right now, and where the outlook is going forward, exactly. Of course. But this has nothing to do with any of that. And I think valuations are actually at the higher end, at the highest end almost of, like, if you look at cyclically adjusted valuations, and we talk about that in our webinars, we're at the high end of that over the last 20 to 50 years, really. And so, the expected return going forward, it will be difficult to have gains over the next 4 years, like significant gains. Now, the market is bifurcated. There's, on the mega cap 7, 8, 10 companies, or the top 10 companies are 38% of the market right now, the S&P 500. So, and they're trading at 31, 32 plus times earnings. So versus the other 490 stocks in the S&P 500 trading at about 19 to 20 times. So you're probably down market. I mean, it's not that far down market. You're talking 10, and then you go to 490 and down. But you probably find better value there. But do we think it's going to be easy for the S&P 500 to do what it did over the last 3 years, over the next 3 years, or 2 years over the next 2 years? That would be difficult. You've had a historic run again. Are you going to see 30-40% gains in a broader index over the next 2-3 years? That would be probably difficult. So is that Trump's fault? Likely not. Like, that is not. And was it Biden's policies that led to the gains in the last 18 months? Likely not either. So, a lot of these things are set in motion well ahead of
just on
market
that
as well.
as well. Goldman Sachs actually recently came out with a forecast for the S&P 500, and they're estimating average annual returns of the S&P 500 over the next 10 years of 3% annually. Given the fact that valuations are so high. So that's kind of the, that's kind of, it's not, like necessarily that we're expecting a cataclysmic decline, but rather, given that valuations are so high, it may take time for earnings to catch up.
Yeah, and we referenced that. We're using that in our podcast that we just did, and that expected return going forward is, it's going to be difficult for the broader exchange, with 38% of that being these 7 to 10 companies that have PE multiples right now going forward of 31, 32. That is, you got to grow at a high rate over the next 3 to 5 years to continue to hold a PE of that level. Those are great companies, but as a minor setback, and that they get a cold or catch of the sniffles, and it's almost like a cold for the market. That's what's going to likely happens in those cases. And there are some of those companies that could be due for a 20-15% pullback, and that wouldn't be it would be probably healthy for those businesses, but it can really affect the market when they're 36-38% of the market, right? So there's probably more value down market. There's a couple names of those 10 companies that we probably still like right now, but I don't know if I'd want to buy an index fund, is what I'm saying right now, because of that expected return. You can probably do your research and find some down market a little ways. All right. Was there anything else on the poll, Brennan? Did you say where you were?
I voted no change. But I mean, it is kind of funny too, just like, self-deprecating as I always am. But just my whole 2024 prediction of Tesla being under $240. Well, like Aaron said, it's just like, I put this forecast out there for, kind of a near-term, short-term forecast of it being under $240 per share. They come out with some crap earnings, which I was kind of expecting. All of a sudden Trump or Musk, ties himself with Trump, and now all of a sudden we're seeing, Tesla up to like $330 or $330 per share. So that's not going so well for me. But
hard to predict those things. Yeah.
Yeah, exactly.
Well,
we'll laugh at it, or we'll laugh at myself a little bit more next year, with just in a few more months when we do our 2025.
You have a couple months.
Months.
And thankfully, our individual stock recommendations are doing a lot better than Brennan's,
including a couple of the stars
predictions, right? Yeah, for sure. And we'll talk about a couple of those today, and that kind of dovetails into our 2 stars. So we might as well get into those. So the company I'm going to talk about today is Argan Inc. It's a company that we'd had in coverage since March of this year, around the $49 range. Today, the stock trades at $154, $2.12 billion market cap, about a 1% yield. What does Argan do? That's important. They're primarily a construction firm involved in the power industry, about 74% of their business. Industrial construction is about 23.5%. Telecommunications is just 2.5%. That they conduct operations through their wholly owned subsidiaries. The company provides a full range of engineering, procurement, construction, commissioning, maintenance, project development, and technical consulting services to the power generation market. Argan services their service offerings focus on engineering, procurement, and construction of natural gas-fired power plants and renewable energy facilities. So the question is, why is it a star? Why is it up 36% in the past month? And why up 229% year to date? I've seen a few analysts suggest that Argan was a stock to buy if Trump won, the theory being in terms of construction and engineering sector, generally Argan is part of it. And Trump is aiming to charter 10 new cities on underdeveloped federal lands and streamline approvals for infrastructure projects. This is essentially just good for energy infrastructure projects. So good for Argan, as you can see there, the Trump trade. Now, it could be that, but the more tangible reason that this stock is actually moving higher is blowout earnings, which is typically the case when you see a stock move higher, at least sustainably move higher. They had great Q2 numbers. The stock smashed analyst consensus earnings estimates and easily beat the most optimistic street estimates on earnings. This drove the stock higher. Year to date, the gains are just really a continuation of this trend, positive outlook in quarterly calls from management and backlog moving to record levels from significant contract wins. So let's take a closer look at those Q2 numbers. We can see here revenues up 61%, earnings up around 40%, gross margins were lower, which is something we are monitoring, but this was largely due to a changing product mix in the quarter and will fluctuate with differing projects. Something, again, that we do monitor. It shows you a continuation, if we look here for the 6 months, continuation of the growth seen in Q1, an acceleration really in Q2 on the top line. The key drivers moving forward would be strong contract wins in quarter, which pushed the backlog to $1 billion. This is the balance sheet here, as you can see, very strong. I'm just going to pull back here and look at these 6 months here. If we comment on the current backlog, what did it go to? $1 billion. It reflected an increase from last quarter of approximately $210 million and includes about $570 million of renewable projects. When management commented on the backlog, they stated the addition of high energy demand data centers, the onshoring of manufacturing operations, and the expansion of electric vehicles usage is primarily driving increased forecasts of future electrical power demands and the robust pipeline of new business opportunities. So Argan's pipeline remains strong, and the company is confident that their energy agnostic capabilities and proven successful business leave the business well positioned to compete effectively for a growing number of projects in the market, particularly in the electrification segment. One of the elements that attract us to Argan, which is a volatile business than we traditionally recommend, probably more volatile given the contract-driven nature of its work, was the very strong balance sheet. We see that here. As you can see, net cash position significantly there, and that project backlog you can see going higher, which is the net liquidity is about $260 million in the quarter, and that keeps moving higher. Let's look at the valuations. This again is the backlog. If we're going to look at that, that was the $1 billion backlog. We talked about that. I'm going to look at the valuations now. The estimated this is based on the estimates that are out there right now for earnings in 2025. PE is 36.8, 2026, 31.3. These may come down a bit as the backlog is increasing and earnings beat should continue into Q3 and Q4. But near term, the valuations are on the higher end of the company's historical metrics. So that is of note. I will conclude here just by saying clients will be updated over the next week. The 36% boost this month and the 220% gains this year make Argan our star of the week.
So one thing I just want to add, like, just so that you can kind of like highlight it for the listeners here, is you had mentioned that Argan is it's a fairly volatile business, which is something we see in the construction space, meaning that revenues and earnings can fluctuate a lot from year to year. Maybe is there two or three things that you really noticed about Argan? Like, what were the top two or three things that caused you to recommend it in spite of the fact that it was more volatile than you typically like?
Yeah, well, I mean, one thing was that gave us this margin of safety was that they had about 40 to almost 50% of the market cap in cash. So,
right.
If you had a crap quarter, if you had a crap 2 years, the company was still going to be around. So you weren't looking at a company that had a high debt load, and they were going to have to service that. So not only do you have, losses or potential shrinking cash flow in a quarter, but you're getting squeezed by those debt payments. So you don't have that, for one. They were trading at a discount relative to peers as well. And we did interview management. The team seemed competent. It was the second time we had talked to them. Plus the estimates that they had going forward didn't seem to be factored into the price. So it was trading at a discount relative to peers who were growing at a lesser rate. If they hit their targets, it was significantly undervalued. Plus, if they didn't, it wasn't going to be a story that was going to absolutely collapse because they had that cash sitting in the bank. And there was an up cycle coming in that segment at some point, and it was kind of starting. If it took 2 years, they certainly had the cash in the bank to wait that out. So, I mean, those are, three of the things that we really looked at: low valuations relative to peers, that fortress balance sheet, and then a good outlook going forward that really wasn't factored in, and really limited coverage, to be honest. So, you could find the potential for a mispriced company. So all those things. They also pay a dividend. So, and at that point, I think the dividend was about 3-4%. So it's now 1%, but they've increased it this year, but the share price is up 220%. So it's hard to keep up to that increase in the price. But yeah, you had all those things working in its favor. Likely we could have sat and waited on that dividend if there were some delays in those projects that they expected to come coming to fruition. So you were going to get paid, you had that cash rich balance sheet, and you had a discount to peers. So a number of those things. Plus, in the interview, like we said, they seemed to be a competent management team, and they hit their targets after they said they were going to do this amount in earnings coming forward, and they hit that. And then we said, okay, if they're going to continue to do that, that maybe this is a viable recommendation we can make. Certainly on the higher risk end, but obviously it has worked out tremendously well over the course of this year. I mean, it's about 6 to 7 months. We would not have expected it to do that over a 6 to 7 month period, perhaps over a 2 to 3 year period, but it's great to see for our clients. All right. Should we move forward? Brennan, you have another star, and
Sure.
Coincidentally, this comes from our US growth and small cap kind of area of the research as well. A company that really just in the past even month after their record earnings came out has really surged.
Okay, so yeah, thanks, Ryan. This star of the week, or the second star of the week, we have here is Prodex Inc, or PDEX on the NASDAQ. This is a company which we recommended to clients back in June of 2023 at a price of about $19 per share, and clients had the opportunity to continue to add all the way down to $15 per share. Now, the company is our star of the week, as it is up about 54% in the past month and 139% since our initial recommendation, where it was currently trading at this morning about $45.50. But I think it's actually about closer to $49.50 right now as we record this podcast, because the stock is up even more in the afternoon session today. So if we use, that original $45.50, it has a market cap of about $148 million. So Prodex is a medical device manufacturer, which specializes in the design and development of autoclavable, battery-powered, and electric multifunction surgical drivers and shavers used primarily in the orthopedic and maxillofacial facial markets. We recently updated clients following its Q1 2025 results, which were stellar. But let's take a look at what's driving the increase. So first and foremost, the company's strong financial results are driving the share price higher. With looking at Q1 of 2025, revenue was up approximately 25% year over year, and adjusted EPS was up 13% year over year. Now, number two, the company posted record backlog in the most recent quarter, up to $58.8 million, up sequentially from about $19.8 million in Q4 of 2024 and up from $35.7 million in Q1 of 2024. So backlog is very strong right now. The market clearly liked that, and that's kind of why we saw the big jump as well, on top of just the good earnings figures. And as well, another positive is that the company's gross margins have been recovering up to 35% in the last quarter, which is the company's highest gross margin posted since Q3 of 2021. So it appears the supply chain issues, which we initially highlighted during our initial recommendation, are starting to abate. And this is really just a good case study of a stock which offered, kind of an asymmetrical risk reward opportunity while it traded at about 14 and a half times earnings. And I'll go through our investment summary, which was included in our initial buy report, which was published in June of 2023. So we noted since 2020, Prodex has taken on additional debt to purchase and outfit its new 25,000 square foot facility. So they were bringing on additional capacity, and they were about like doubling capacity, which was just coming online. So we saw, this runway of growth. The company had a great track record of long-term growth. So, from 2014 to 2022, revenue grew at a compound annual growth rate of about 18.5%. So they had a nice track record. Earnings, have been more volatile, but again, there's a nice trend in earnings over the long run. They were facing some supply chain headwinds in 2022, which a lot of companies were around the world just because of the pandemic. But management was confident that they could get gross margins back in the right trajectory. We noted that the stock does have a high degree of risk because there's a high amount of customer concentration with the business. But, it all came down to, the thought of if management can sustain the business's historical growth trajectory while, margins start to recover and they fulfill that new capacity coming online, this business appeared to offer growth at a reasonable price. So all in all, it was really this thesis of additional capacity coming online, which management said they believed they could fulfill, which they did, along with a normalization of margins, which, were quite depressed when we initially recommended the stock. So we were just kind of looking for, a rebound at that point. And as such, management executed on what they said. The financials improved significantly and propelled the stock higher, which has obviously made it our star of the week. And I would like to congratulate clients who own it.
Brennan, you say you're looking for a rebound. I thought you were looking for a solid, steady relationship with the stock.
Yeah.
With the stock,
Yeah.
Brennan, the stock down. No, yeah, rebound. No, it's performed tremendously well. The earnings were very strong, and
Yep.
the backlog increase really helped, and it's definitely nice to see. We actually, we just talked about our webinars. We happened to recommend it in our webinars literally about a year ago to date.
Yep.
And if you attended those webinars, the stock has done tremendously well. So again, get on demand. You'll get our 5 to 10 or 5 to 6 stocks that we that are recommending today. And if one of those companies does half as well as Prodex did over the course of this year, it'll pay for that price of admission for sure. All right, let's move on to your stock, our take on BCE. Aaron's going to answer that. Aaron actually had this prepped last week, but he literally lost his voice. Correct? You couldn't speak last week. You were speechless because of
I
BCE,
could speak.
or?
It just did not.
No, it was horrid. It was horrid. He
Yeah.
he phoned me and I said, "What?"
I was ready to go. I just
Scratchy.
didn't think that I could get through the segment. I had a conversation right before calling Ryan, and about 5 minutes into the conversation, I was almost losing my ability to speak. So
There's
voice
so
is a
much
little bit better now, or at least as good as it's ever going to be.
There's so much sickness going around now. Like everybody's been sick, I swear. I think except for Brett, right? Yes, we've all
Brett's a
fallen
machine.
ill.
Brett's,
Yes, well,
Brett's
that's
a
true.
machine. Come on.
I've been sick
runs-
twice in the last 2 months. Like I was sick before I went to Vegas. I went to Vegas and then I came back sick again.
You're just sick, period. So.
Yeah.
Excellent. Okay, so let's get into BCE here. BCE Inc., one of the largest companies in the Canadian market, telecom, the largest telecom player. It's trading right now at a stock price of $38, $37 billion market cap company, and a huge yield of 9%. I mean, we get a lot of questions about BCE because of that yield. It's not often that you see a yield that high on such a large company in the Canadian market. So what do? Well, they're a wireless internet service provider. They are one of the big three. So there's BCE, Rogers, and TELUS. BCE has roughly 10 million customers, and they make up about 30% of the market. So think about telecom. Telecom is widely considered to be one of the more stable sectors in the Canadian market. And a lot of people go to these stable sectors like utility telecom, to get a yield that they, or a dividend that they believe that they can rely on. So when people see this 9% yield, they certainly have questions about whether or not this is sustainable and if this is a monumental opportunity to purchase shares of BCE. We actually had coverage on BCE many years ago in our income research as one of our original recommendations, and it performed very well back then. So well, in fact, that the valuation got expensive due to share price appreciation. And at a point, we decided to sell and move on to some other names. But what has been going on recently with BCE? Well, the stock price took a major hit on November the 4th. In a single day, it dropped 10%. And this is after the company announced that it plans to acquire a Ziply Fiber for approximately 5 billion Canadian in an effort to expand into the US market. So after that announcement was made, the stock price declines 10% on a single day. And since then, it's continued to decline. So it's now down about 14% since the announcement was made. Clearly, this is an indication that the market is not particularly enthused about something. So we'll take a look and try and figure out what this is. But this wasn't the beginning of the company's problems. BCE has been performing not very well over the last couple of years here, really since the interest rate tightening began in 2022. And this makes a lot of sense because given that it's a large, lower growth dividend payer, it's typically going to have an inverse relationship to interest rates. So interest rates hit these large cap dividend payers more so than they typically do other companies like growth stocks. And the reason for this is because a lot of people will go to BCE for the nice dividend, but if they can get a nice income yield now from a GIC, then they start to potentially look elsewhere. So the company's really been trending downward over this period since the tightening began. But now that this is reversing and interest rates are starting to go down, we still haven't seen any recovery in this company like we have in a lot of other sectors like utilities and REITs. Right now, BCE's stock is actually trading at about a 13-year low. So any investors that have been in this stock for the past decade plus, the only return they've really been receiving is with the dividend. So I'm going to just take a look at what the company is expecting in terms of financial performance for 2024 to kind of get some clarity on why the stock price has not been performing better. And what I'm seeing here, and this has really been the case with BCE for the last couple of years, is lackluster financial performance. So we'll take a look at the revenue growth. Even last year, revenue growth was not very strong, only 2.1%. But this year, they're actually expecting a decline in revenue of about 1.5%. And they actually had to update their guidance when they just recently released their Q3 results. Previous to that, they were estimating 0% to 4% positive revenue growth, and now they're looking at a slight decline in revenue. So really not great news there. Adjusted EBITDA growth last year, 2.1%. This year, they're estimating between 1.5 and 4.5, so that's 3% at the midpoint, comparable to last year. But then we go down to adjusted earnings per share. That was down last year, and it's expected to be down again this year, down between -2%, -7%. And the same goes with free cash flow. It was up a little bit last year, about flat, but the free cash flow is expected to decline anywhere between -3% and -11% this year. So we're really not expecting to see a great rebound in the financial performance in 2024. And then looking at 2025, right now we don't have guidance, we don't have any forecasts out, but it's still looking fairly lackluster, even if growth resumes. What we would be expecting, even in a good year for BCE, would be mid single digit growth based on what they've been producing recently. But in spite of this, they have continued to grow their common share dividend, and some people will think that that's a good thing. We do not necessarily. Certainly, if you're just going through 1 or 2 years of negative growth and that's expected to reverse, I I like the consistent dividend growth strategy. So maintaining that dividend growth is a fine thing to do. But the problem with BCE is when we take these growth projections for 2024 and we actually calculate what the expected earnings per share and the free cash flow are, you can see that the payout ratio is significantly above 100%. And that doesn't matter if you're calculating the payout ratio based on adjusted earnings per share or if you're calculating it based on free cash flow. So 130% payout ratio based on adjusted EPS, considering the company's guidance, and 125% based on free cash flow. So this is not a sustainable situation. A payout ratio above 100% basically means the company is paying out more in dividends than it's actually earning. And there's eventually companies have to reverse course on this type of a strategy. We would really see a reasonable payout ratio for a company like BCE, ideally to be in the 70 to 80% range. 80 to 90% would be okay, but even that, the margin of safety is getting low. But significantly above 100%, like what we're seeing for BCE, is not a sustainable situation. So when we look at that 9% yield, a significant portion of that dividend to produce that yield is being financed either with debt or with share offerings. I'd also like to just take a quick look at the balance sheet as well. Balance sheet, debt leverage. This is really the foundation upon which the business is built. If you have too much debt, that adds a lot of risk. It really limits your ability to invest in the business. It limits your ability to go out and acquire other businesses as well. So BCE has total debt of about $40 billion. They're estimating adjusted EBITDA in the range of about 11 billion. So that would be a debt to EBITDA multiple of 3.7 times. Now, normally I would not think that this is extremely excessive for a large company in a stable sector like BCE, but I would certainly say that debt to EBITDA of 3.7 times is fully leveraged. There's really not a lot of space for that leverage ratio to go up. So you have a payout ratio that is well above 100%, a debt to EBITDA multiple that is basically as high as we would like to see it. We'd even ideally like to see it a little bit lower. There's just really not a lot of flexibility for BCE right now. Now, they did announce that intent to acquire Ziply Fiber. This is a leading fiber internet provider in the Pacific Northwest of the United States. So $5 billion is the acquisition price. And what they're looking to do is to grow into the US market. And this acquisition is expected to close in the second half of next year. Now, in order to finance this acquisition, what they're doing is they've announced the sale of their minority stake in Maple Leaf Sports. So this is part of the major asset there would be the Toronto Maple Leafs. They have a minority stake in this. This is a non-core asset, meaning it's not part of the main business focus, which is telecom. So they've decided to divest this for $4.7 billion, and then they're going to sell that to Rogers Communications, and then they're going to use that money to purchase Ziply Fiber, assuming that all of the approvals are met. And the sale of their interest in MLSE is also expected to close in mid-2025. So at the very least, they are able to sell a non-core asset to buy something that is more core to their business. So it doesn't seem like they're going to have to increase debt very much in order to make this acquisition happen. So that's a good thing. As I said, the leverage ratio was already high. And I also agree with them doing this. I mean, the market likes businesses that are very focused on a specific market or industry. The market is usually less enthusiastic about companies that kind of have, assets in a variety of different industries and like a lot of non-core things that they're doing. Investors like focus. So this is probably a good move. I don't know much about Ziply Fiber. It's not a situation where I'm really going to do a lot of in-depth research on it if I'm not close to recommending BCE anyways, which I am not. So this is just a situation we would have to see how it plays out. Certainly in the United States, there's going to be more competition, but it could alleviate the problem that they have where in the Canadian market, there's just not a lot of growth in telecom. So what is our take? Some of the good things that I can say about BCE, we love essential assets, and telecom is absolutely essential. BCE, we do not believe is going anywhere. It is trading at a relatively low valuation, about 12 times earnings right now. So we would consider that, relatively low, and it has that high yield. But the problem is, just really weak growth, not great share price performance, poor shareholder returns, and that payout ratio just being unsustainable. Now, I don't necessarily believe that BCE is going to have to cut their payout ratio right away. They can probably continue to finance it with cash flow that does not come from operations. We just think that there's going to be a point where if they cannot grow into that payout ratio, they are going to have to cut it, or they're just going to have to increase their debt too much. So we like companies that are able to maintain and grow their dividends with internal free cash flow. And not be reliant on outside financing. So while we certainly like a high yield and we like dividend growth, the payout ratio is not sustainable. So that's just a no-go for us. Now, lower interest rates will help BCE. I do believe that with the acquisition, they're going to put a pause on the dividend growth. So maybe that will give them an opportunity to catch up, for earnings to catch up with the dividend. But until that happens, we're not going to speculate on, where interest rates are going from here or how that's going to affect the company. There is risk in this acquisition that they're doing, even though it may be ultimately a good move for them. So there's just too many unknowns for the company right now. I would say, kind of as a speculative rebound story, there could be an argument for a small position, but it's not what I would consider to be a solid, sustainable dividend growth stock, the likes of which we would like to invest in. So we're on the sidelines on BCE right now, and we'll just monitor the company and we'll see how things go.
Yeah, I mean, it is crazy how if you look at the performance of BCE over the past 10 years, and like this is a stock that you see all over BNN, you see, portfolio managers all across the country, putting in portfolios being a big part of it. And, it's literally down from where it was 10 years ago. There's been a good dividend yield there, but your total return is getting crushed by so many other companies. The index, the U.S. market index, the Canadian index over that 10-year period, and the company has not performed in and driven portfolios. I mean, it's funny because I had a client call this morning, and we were going over 10 stocks that were in there, and these are 10 stocks that you probably don't find in the majority of Canadian portfolios. They come from our research, and all 10 of those, when I look now, would have significantly outperformed BCE over the past 10 years. So you hear about BCE a lot, not necessarily the best stock to have been over that period. And that ownership they have in MLSE, I do agree they should focus on what you do. I mean, MLSE basically owns every Toronto-based sports team. They own like the Leafs, the Raptors, the Toronto FC, the Argonauts, the AHL team, and the Raptors G League team, and on a bunch of other teams as well. They own everything. It's not really core to what BCE was doing. They made money off of it, so good on them for that. From the purchase price, as far as I understand, significant, but it's not core. Do what you do best. Maybe they can start to grow in that area. Finally, should we just move on to our last company? Brett, you're going to take a look at that. And that company is Neptune Digital Assets Corp, right?
You got it. Yeah. Got this question. We've answered a couple questions from before. Shadow Jedi 007, I think, is the username. But he asked about Neptune Digital Assets, and he mentions that he's a long-term bag holder. And recently, he's finally broke even and then some, and asked now, should he continue holding it or not? And as well, he just comments that he's attending one of our webinars, or has attended, I'm not sure. This would have been a week ago. So attend our webinars on demand, likely by the time you are watching us, but you should attend. Neptune Digital Assets, symbol NDA on the TSX Venture, operates in the cryptocurrency and blockchain space. Neptune engages in operations across the digital asset ecosystem, including Bitcoin mining, proof of stake, blockchain nodes, decentralized finance, commonly known as DeFi, and associated cutting-edge technologies. So effectively anything in the cryptocurrency ecosystem. The shares are currently traded at 98 cents a piece, resulting in a market cap of 125 million. The stock is up a whopping 139% year to date, but they were relatively flat as far as cryptocurrency related companies go throughout the year. But then they finally surged in late October, and I will go into why. And it was due to a corporate update announcement on October 25th. In that last slide, you can see it just went vertical on that date. So really, I'm just going to go through what they stated in the update. It was nothing really groundbreaking, but it really put some eyes on the company. So from a mining and staking, which is either Bitcoin mining or various cryptocurrency staking, depending on which one, Solana being the second major cryptocurrency, which I'll go into in a minute what they're holding, but Bitcoin mining, Solana staking, is bringing in about 220,000 revenue per month, 2.6 million per year, using the run rate from their last financials for the cost, which will be relatively similar despite the revenue changes over time. It brings in about 1.1 million gross profit per year at the current prices before any overhead. Then once you include the corporate overhead costs, excluding the gains and losses from digital assets, you come to about 2.1 million in cost, effectively meaning the company relies on the appreciation of its digital assets, Bitcoin, Solana, and so on, to have any profitability at this time. Crypto prices are volatile, as well as either staking yield or the Bitcoin network difficulty. It changes over time. You can never really analyze mining and staking revenue in dollars at a point in time and then expect it to hold for the next year. It's going to change. It's volatile, not just the price, but also the conditions, which give you the additional either Bitcoin or cryptocurrency. The costs, however, are more stable, as it's relatively, for Bitcoin mining, it's electricity is the main cost, as well as the cost to acquire the miners, and then staking has just minimal costs in general. So moving to the asset value, the majority of its holdings are in Bitcoin, holding 349 Bitcoin worth approximately 42.5 million Canadian at this time. But by the time you're watching this with cryptocurrency prices, that's probably going to change quite a bit, and that's the same with any major crypto asset. The second, like I said, was a major asset they have on their is Solana. They have both locked and unlocked Solana, meaning they cannot sell the tokens natively until certain dates, as they are locked, with the majority of the being unlocked on a monthly basis until January 2028, and about 20%, I think it was January 2025, they get a lump sum unlocked. The locks of Solana was purchased at a significant discount of 67% early in the year. Really, they didn't state it directly, but it likely originated from the FTX bankruptcy proceedings, as a bunch of things came out at that time, and that corresponds with the discount they received. I do have the locked Solana value at the full price in this table, but likely if Neptune did decide they won't need to sell it now, they'd likely have to sell it at a discount. But later locked Solana auctions relating to the FTX bankruptcy, they had less of a discount, so they likely still have made money off their initial purchase price. In total, the crypto assets listed in the press release total 54.6 million at the time. And once again, crypto prices are volatile. By the time you're listening to it, it could have materially changed. The other investment, which I will highlight, is they actually have 4.2 million in SpaceX shares. If you value it off the last SpaceX share issuance, as well, the company had 4.6 million cash. So total assets come out to about 68 million Canadian, or 48.7 million US, and that represents about an 84% premium compared to the market cap. And as I was going through before, the actual operations of the company don't really bring in money, so you're looking at much more of a value. Most of their value in the company is derived from their holdings and not their actual operations. And even further, they're seeming to be slowly winding down the Bitcoin mining operations that they sold, as they have sold some of the miners over the past year. Next, the next press release I'd like to highlight is on October 30th. They are embracing the MicroStrategy playbook with a 25 million US credit facility. Effectively, the MicroStrategy playbook is raising capital through debt or equity to increase the per share holdings value of Bitcoin. So if you have one Bitcoin, they'll issue debt or equity, and they hope to raise that to 1.1, 1.2, and so on. They describe that as their Bitcoin yield, but I think that's a bit misleading calling it a yield, but that is what they call it. If you do see that phrase, it's just really how much they can increase their per share Bitcoin count per share. Something like that. Some of those words don't make sense. So Neptune, however, is expanding this to encompass other crypto assets, mainly Solana. prior to any credit facility drawdown, the company is actually debt-free, has a clean balance sheet as far as liability is concerned. The only liability they actually have is a couple $100,000 in accounts payable. So very clean balance sheet as far as that goes, especially for a cryptocurrency company. They can get very messy very quick. So going a bit more into the MicroStrategy playbook, as they call it. So for debt, it is similar to margin trading. You can picture it like that. You are levered. You'll pay an interest rate. The benefit from MicroStrategy's point of view is they had issued their debt when interest rates were very, very low. Their debt interest rates is somewhere around 1%. They also benefited from having a legacy business, ultimately resulting in a very low cost of debt than anyone margin trading Bitcoin or any other asset, really. Neptune won't be able to access this bottom of the barrel rate interest rate as interest rates have moved higher. They are smaller than this credit facility compared to a bond issuance. They do state it's a very low cost to capital, but don't state a figure. But it would likely still be better than the margin rate if you were to compare it to that. But they will still ultimately be paying interest higher than MicroStrategy by quite a bit. So then if you look at the other side, you have debt, raising capital through debt, now onto equity. And this only really works if you're looking to increase your per share value of cryptocurrency, if the equity is trading at a premium to the underlying assets, which it is right now, but it is not a given. Right now, I could do like I was saying before, which is why I went through that. Its market cap is trading at a 84% premium to net asset value. So at this time, if they were to issue shares, they could increase the per share holdings of its assorted cryptocurrency assets, mainly Bitcoin and Solana. But this only works because you are holding shares at a premium to the net asset values. If the shares are already trading at a discount, it will actually slowly decrease. It will dilute your holdings of your cryptocurrency assets on a per share basis. The premium is effectively based on market sentiment, adding a lot of risk to it and further volatility on top of an already volatile asset. So you're absorbing a lot of risk just to get this potential Bitcoin yield or cryptocurrency yield, which should not be called yield, in my opinion. Overall, to even consider investing in Neptune, you need to be bullish on cryptocurrencies, notably Bitcoin and Solana. But even then, you are paying a premium. Yes, the premium can always go higher, and we've seen that in MicroStrategy. But in the case of a significant collapse of cryptocurrency prices, which you've seen many times at this point, you would not only see the net asset value times, but also that premium would likely vanish and could potentially go into a discount, which Neptune was even trading at only a couple months ago. Further, assuming Neptune does end up using its credit facility to buy cryptocurrencies, the risk is significantly heightened in a downturn, as assets would need to likely be sold to keep up with those interest payments, as the company's operations in isolations of digital asset sales are cash flow negative. The other option is share issuance, but at that time, the share price would likely be depressed, so you're issuing at suboptimal pricing time. Overall, I would not want to hold it when it's already trading at a significant premium in the hope the premium stays the same or rises more. You're just relying on market sentiment on an already volatile asset. Further, this would not fit in any way into Keystone investment criteria. At this time, the Neptune is more like a fund. It's just holding assets, and it doesn't really have significantly value-producing operations.
So the company can do better if sentiment stays the same, if crypto goes higher, and if management executes, and a number of other ifs. So, I mean, there's probably less risky ways with less probably downside to play cryptocurrency if you really wanted to, is what kind of you're saying.
You need to rely on that premium staying the same. And in market downturns, MicroStrategy, Neptune, they've all collapsed into a discount at a time. So you lose that premium, you lose the net asset value, and so on. It cascades very quickly.
Yeah. I think that summarizes it pretty well. Is there any further that we need for this week, or should we get out of here and reconvene next week at the same time?
I think we have a webinar to do here.
That's true. We've got that to do. Got a couple calls to do, so we're going to do that. Get back to some work. All right. Keep your questions coming in for our Your Stock, Our Take segment. We'll endeavor to answer those on a weekly basis. If you're watching this on YouTube right now, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.